Dhananjay, you had a report which you put out earlier today. You
Mhm.
don't seem to agree with the Reserve Bank of India's decision to loosen the bank lending to NBFCs and to the microfinance industry. The RBI reversed its decision in about just about 13 to 14 months, and you don't seem to agree with it. Why is that so?
So if you look at it, I think the major reason why RBI had put out a sort of a restraining measures back in November 2023 is largely because they were concerned about the broader context of exuberant retail lending, especially the uncollateralized lending, and that was applicable to banks. It was applicable to NBFC, microfinance. Also, they had come up with, uh, you know. A more stringent monitoring of subcategory within the retail lending. So if you look at the entirety of things, it was more to do with the default risk that the RBI was expecting from the large retail lending or exuberant retail lending that was happening at that point of time. So the thing is, we have been flagging this for some time, but I think what we found is that relative to the income growth, the lending growth on the retail side was very high, and hence the default risk was imminent, and RBI responded with a certain lag, I would say. If you look at the current scenario, they are basically addressing one part of the entire measure that they have taken, largely addressed towards NBFCs and microfinance companies, whereas other components are left as it is. So I would say that if that was the purpose of at that point of time, that they were concerned about the default risk at this juncture where income growth has slowed or worsened more, and the leverage of the household is at a peak level. If you are actually easing certain stringency as far as retail lending is concerned, it is not very clear, you know, whether the RBI's objectives of financial stability through such measures has been attained or not. Because at this juncture, our worry is still that the retail lending default risk is just about emerging. So I think they might be easing prematurely where when the risk is still existing.
Do you think that there was some kind of a clamor from the banks that they should be allowed to lend to the NBFC, given that rate of take has not been that great?
So I think, see, what was happening earlier was that while the uh, while the bank lending under personal loan was actually growing very rapidly, the banks are also expanding their retail lending through the NBFC route because that was also growing very rapidly. So in terms of the entirety of retail lending through their direct book and also through the NBFC is very strong. I think when the RBI increased the risk weightages on NBFCs and MFIs, what has happened is that the flow of money from banks to NBFCs got somewhat tapered, and as a result of that, the NBFCs actually relied on other sources of funding such as ECB, etc. So I think what you see now as a flip in the overall policy is basically coming. I think it is coming largely from the NBFC side rather than from the banking side. So I think that is something that we have sort of elaborated, that possibly the debt servicing of such liabilities have actually increased quite significantly because of the rupee depreciation. So I would say that the the uh, the pressure appears, or the request has come from the NBFC and the MFI industry rather than from the banks.
You also see a currency and a ECB angle to this relaxation. Can you explain what exactly do you think would have happened?
So if you look at the period after the RBI increased the risk weightages for bank lending on NBFCs and MFIs, these entities actually relied significantly on the external commercial borrowings, and we have highlighted that the average monthly inflow of ECB, the money raised by the NBFCs and MFIs put together through ECB is actually averaged about $2 billion dollars per month for the 9 month ending December, and that was a growth of almost like 130% over the 9 month prior to November 2023. So there has been a significant jump out there, and in the context that so that was happening because it was cheaper for NBFC or such entities to borrow from abroad, and also the fact that they were constraining flows from banks. And the third thing is that the rupee was also held very stable by RBI through interventions that RBI did, and that was a very healthy situation for the NBFCs and MFIs to actually borrow and keep the cost of fund low or manageable, despite the fact that their growth had been slowing. So what has happened is that more recently, with the rupee depreciating very sharply to something like 87, 88 levels and likely to go up beyond 90, it's the servicing cost actually would have actually increased. And also, I would say, there has been a certain rollover, or a third of the ECB that they're mobilizing is a rollover from what they did, let's say 5 years back. The average maturity has decreased. So essentially, there is a rollover that is also clogging the demand for rollovers of ECB. So I think the debt servicing for the MFIs and NBFCs has increased very rapidly because of the rupee depreciation, and I would say there is a rush back to bank deposits, bank loans, because that comes under that is a rupee denominated loan. So that switch from dollar to rupee loans through banks is something that required the easing, and hence I would say the earlier stringency that RBI had put up actually may have been a sort of a hindering factor. And I would say RBI may have accepted the request from the NBFCs and MFIs to ease that norm, and I think that is why this ECB and rupee depreciation equation is a very important variable that may have guided towards the relaxation that we saw recently.
Why do you think then that the withdrawal of this stringency is not a great move at this juncture?
So the thing is, if you look at the banking sector, the deposit growth has been unmatched with the credit growth, despite the fact that the credit growth has decelerated. The CD ratio for the banking sector is at an all-time high of 80.4%, and as a result of that, the ability of the banks to accommodate furthermore loans, now this through the reduction in the the reduction in the risk weightages for MFIs and NBFCs would imply that the pressure on the banking sector for additional loans would actually increase, and that comes at a time when the CD ratio is at a high level. So I would say that what it would do is to really constrain the liquidity pressure in the banking system that we are seeing. So if you look at the banking system, despite the RBI's rate cut by 25 basis point to 6.25%, there has been a liquidity deficit that has been persisting over the last few months, and largely to do with the fact that rupee has been depreciating and RBI has been selling dollars, etc. If you have a combination of intervention and the additional demand for credit coming from the NBFC sector, that combination would actually accentuate the liquidity deficit significantly. And we have seen that despite the rate cut and infusion of liquidity to the tune of almost like 4 lakh crores, the liquidity deficit still remains. And hence, rate easing and accommodation has not really worked. And this switch from ECB to the bank loans by the MFIs and the NBFCs would actually accentuate the deficit. So I think that complicates the scenario for the RBI and the banking system to manage liquidity, manage currency, and still make funds available for additional such demands of credit.
One expectation is that the loans from NBFC sector for consumers would increase as a result of this measure. Do you think that is likely to happen, especially in the context of the government's efforts to boost urban consumption?
Yeah, so I think the government and the RBI is concerned about the slowdown that has been there now reflecting in the urban consumption. Also, I think it is more to do with the urban income and the context that there is a cost of living that is rising and tax incidence is very high. So I think what the government has done is to relax the income tax incidence, and that amounts to an estimated 1 lakh crores of tax losses for the government. That is assumed to increase the disposable income in the urban areas, especially in the formal sector. And what appears to be the strategy is to really leverage that and somehow create a sort of a leverage consumption. And I think allowing NBFCs, greater access to bank credit. The whole idea may have been to create a kind of a consumption leverage based on such moves. So I think there is a increasing acceptance of accommodation by the RBI through rate cut, CRR cut, and all these measures that they're doing. So I think that's the whole strategy that the government and RBI may be having. Now we'll have to see whether this can actually work out or not, because at the end of it, these measures do not sort of address the problem of deposit growth, which has been very modest. I would say it's been slowing for a long time, and I think the last 10-year average is just about 10 odd percent. So I would say that is more to do with household income, wage growth, real income, etc., and that I think measures such as liquidity infusion, etc., do not address. So I would say that the RBI and the government is trying to implement a certain counter-cyclical policy in a context where the problems may be actually structural, and hence my sense is that the context that there might be further tightening in liquidity, etc. The transmission of rate cuts, etc., may not happen with this kind of a strategy. We'll need to address the problem of deposit growth and the overall economic recovery based on structural measures rather than such counter-cyclical measures.
How much do you attribute this to change of personnel at the Reserve Bank of India, and how much to change of conditions in the last few weeks?
So
That's
I think the pressure on the RBI to cut rates had been there for quite some time. You will remember that from the government quarters, the argument was that the RBI should ignore the high food inflation, focus more on core inflation because it suited the narrative and the assumption that the rate cuts would actually resurrect growth, etc. So I think that pressure was there on the RBI, and I think general consensus is also building around that. So I think if you look at the change of guards, we see that the new after the new governor has taken responsibility of the RBI. I think measures have been far speedier. If you look at the rate cuts, the CRR cuts. CRR cut had happened earlier, but the rate cuts, then other things such as reduction in the risk weightages for NBFC and MFIs. Then I think there is a proposal to remove the penalty on prepayment of loans, etc. So I think many of these measures are happening. So I think the acceptance of the government strategy that we should have an accommodative stance by the RBI is actually has actually gained momentum after the change in guards in RBI.
Dhananjay Sinha, thank you very much.
Yeah, thank you. Bye.